Okay, hi there. Welcome to a special macro video looking at one of the hot topics of the moment, which is the Turkish economy and their collapsing economy. The Turkish Lira has fallen by more than 50% against the US dollar in just a few months. And in this video, we're going to explore some of the main causes of this and also examine a range of the sort of short and possibly medium-term outcomes when a country such as Turkey suffers such a steep depreciation in the external value of their exchange rate. Well, Turkey is an emerging market country that has enjoyed broad economic growth over the last 20 years or so, but it is currently mired in a period of intense economic and financial instability, hallmarked by soaring inflation, which may well be maybe 2 or 3 times higher than the official figure of 20%. It's a big country, just under 90 million people. It accounts for about 2% of world GDP, and it's a middle-income nation, a country that is outside the European Union, but operates within the European Union's customs union. Really good example of a country that has in the past bidded to join the European Union, currently outside, but is actually within the customs union. It's one of the top 20 countries in the world measured by GDP, and it's also a top 30 country for exports. Exporting is a key part of its growth story. So the collapse in the external value of the Turkish lira is big economic news. And I hope this video will give you some great context for your Year 13 macro papers, be they essays or daily responses. So this chart shows the Turkish lira against the US dollar, and it tells us that the lira has been depreciating against the dollar for several years, but the speed of the fall in the external value of the lira has gathered pace since the start of the pandemic. The latest data from the Financial Times tells me that the lira has slumped 48% against the US dollar during 2021 and is the worst performing currency in emerging markets. So the Turkish lira now buys many fewer US dollars and cents than it did before. What currency system does Turkey operate? Well, it's a good example of a managed floating exchange rate. So Turkey, since about 2001, 2002, has had a floating exchange rate system, but the Turkish central bank intervenes in the markets to influence, to support the value of the currency. And in fact, of course, as the lira has been falling, the central bank in Turkey has been throwing billions of US dollars into intervention to have an impact on the lira. So to try and support the lira, they go into the market and sell foreign currency reserves of euros and dollars, maybe even pounds, and they're buying Turkish lira in exchange. But despite throwing billions of dollars at this, the interest rate cuts ordered by President Erdogan have sent the markets a clear message about the future direction of the currency. So why has the Turkish lira been falling and depreciating so quickly? Well, I guess the essential point is that the fall in the currency is the result of high inflation and also the unconventional monetary policy of the President Erdogan. Turkey has cut, keep in mind, of course, the inflation in Turkey has been going up. It's currently 20% and rising. But Turkey has cut, ordered to by the President, the short-term policy interest rates from 19% in September 2021 to 14% at the moment. There have been a series of 4 or 5 cuts in interest rates, of course, expansionary monetary policy. President Erdogan's unconventional policy is, well, he wants essentially cheap credit, he wants low interest rates, he wants high exports to drive the economy, and he wants big growth. Now this idea of cutting interest rates and making Turkey have a competitive currency to boost exports and attract investment and create more jobs runs completely counter to the conventional view that central banks should be tightening monetary policy, increasing interest rates when inflation is rising well above target. So when the central bank cuts interest rates, What you'd normally expect is the currency falls because the real return on saving money on deposit in Turkish banks will go down. Some investors will therefore switch or shift their deposits out of Turkey into other countries, perhaps including the European Union, where there's a better relative return and certainly a lower risk return. So that then causes an outflow of hot money, which will involve people selling Turkish lira in the currency markets and buying dollars, buying euros, buying pounds. And the increased supply of lira will cause a depreciation. And we've seen that, of course. The Turkish lira has fallen by over 40% in just a few weeks and months. Now, often in an A-level exam, you're asked to examine, assess, discuss, as well as analyse some of the macro consequences of a sharply falling or sharply rising exchange rate. So what are some of the positive macro effects of this dramatic fall in the lira? The most obvious benefit is on the value of Turkish exports. Turkey is an export-driven economy, and a weaker currency makes Turkish exporters more price competitive, priced in overseas currencies in overseas markets, including the European Union. About half of Turkey's exports go to the EU. And exports from Turkey are driving economic growth, with GDP forecast to rise by 7% in 2021. Of course, that's a rebound from the slow growth created by the pandemic. And indeed, exports are growing, and some producers in the EU and in the United States have shifted some of their foreign direct investment to Turkey, benefiting from proximity to the EU, membership of the customs union I mentioned a few minutes before, and also proximity to Asian markets. Turkey, in that sense, is a bridge between East and West. So having that proximity to markets and a competitive currency is undoubtedly a stimulus to foreign direct investment. I was reading an article, I think in the FT a couple of days ago, saying that Bulgarian shoppers are crossing Turkey's western border in packed cars, buses and coaches, taking advantage of the steep fall in the lira to enjoy their own shopping sprees, because of course the Bulgarian lev will have a much higher value as the Turkish lira declines. Has the falling lira helped the Turkish trade balance? Well, to a degree, yes, but Turkey has run a large trade deficit for many years. The deficit's come down since from 10 years ago. It's about half the level it was once at. Export growth has been strong, but of course the value of imports has exceeded the value of exports continuously. So Turkey is running quite a large trade and current account deficit. Well, what about some of the negative macro effects of a depreciating currency? Not just a gentle depreciation, but clearly a dramatic fall. Well, big movements in currencies have both macro and microeconomic effects. And the most obvious and the most immediate impact is on the general price level for goods and services and the real incomes of Turkish households. I'll post a link or two to several nice little Vox Pop video bloggers. The vloggers have been going around Istanbul and one or two other Turkish places looking at how high inflation is affecting everybody's daily lives. The falling lira has clearly caused spiralling inflation. You see, Turkey is an exporting nation, but it's also heavily reliant on importing energy and raw materials, all of which have a fairly low price elasticity of demand. Inflation is running so high in Turkey, some people are saying that store owners no longer put prices on items. So the falling currency has caused higher inflation. Wages are not rising as fast as prices, so real incomes are declining. People with savings, the rate of interest they're getting on their savings is now below the inflation rate, so there's negative real interest rates on bank deposits. And Turkey's credit ratings with the likes of Standard & Poor's and Fitch and Moody's, they have worsened. So the Turkish government have got worsened credit ratings in international capital markets, and that's a reflection of the increased risk of investing your money in Turkey given high inflation. Turkey's economy is actually quite dependent on external financing. So businesses that took out, Turkish businesses that took out debts denominated in dollars or euros, as the currency falls, the real value of those repayments on debt go up because the lira is losing value against the dollar, for example. and lending rates go up, because if you're a lender, if you're going to lend to Turkish businesses, you're going to require greater compensation for the risk of doing so. So it's causing problems in terms of the Turkish government having to spend more money on interest on new debt issued, and Turkish businesses having to pay more for their loans. Inflation's the highest it's been in several years. I think it's something like 4 or 5 times the central bank's target. Here's a nice little illustration from Twitter of the impact of inflation for real people. This one looks at how the price of a breakfast staple, bread, has risen by 40% in recent months. Many Turks can't afford bread, and bakers can't afford to make it because of price controls, and also the fact that the costs of the ingredients are going up as the currency goes down in value. Another aspect of a falling currency, which I think is really worth emphasising, is the fact that many exports require imports of intermediate products. So Turkish farmers often import fertiliser from outside Turkey. Car manufacturers in Turkey import component parts. A weak currency makes your exports more price competitive, but crucially, it also increases the prices of your imports, and that can dull or offset the advantage you get from having a competitive currency. The yield on 10-year bonds by countries, these are the countries in the world with the highest yields as of, I think, the middle of December 2021. Major economy with the biggest yield on 10-year government bonds is Argentina, 51%. Turkey comes second, 22%. And again, just to explain, this is due to the risk that investors take when they invest their money in Turkey, notably from high inflation, but also the fact that the currency is unstable, and any profits you make when investing in securities can be wiped out by a big fall in the currency. So the yield on government debt is going up. And then there's a fourth consequence. We talked about high inflation, falling real incomes, and rising debt interest rates. There's also some evidence of something called a virtual brain drain among many young people. Youth unemployment in Turkey is very high. I think it's something like 23-24%. And unemployment generally is about 18 to 20%. But youth unemployment is very high. Lots of young people want to leave, but many can't afford to leave because inflation has eroded the real value of their savings. There's some evidence that what we're seeing is a virtual brain drain. So a virtual brain drain is when Turkish people decide to stay in the country, perhaps staying at home, but they try to find work with overseas businesses, in particular maybe tech startups and tech businesses from the United States. But any other overseas business that's willing to pay them in US dollars. So you can stay at home and effectively work for an American business or British business, what have you, get asked to get paid in US dollars. Because of course, as the Turkish Lira continues to decline, the value of the US dollar earnings goes up. And this is an article here from the FT. The Lira slide pushes young Turks to virtual working overseas. And that can actually crowd out the number of people available to work for local businesses. Unemployment is high and rising in Turkey, 14% officially, unofficially higher than that, and youth unemployment is well over 20%. Well, perhaps the biggest risk of this currency collapse for Turkey is that people will essentially lose faith in the Turkish lira as a currency, as a store of value, particularly amid sharply rising inflation. And that's always the danger when inflation gets out of control. It gets to 10, 15, 20% and more. Millions may opt to withdraw their money from the banking system, prompting a run on commercial banks. And that could then lead to a financial crisis, more general crisis, such as that's clearly affected Argentina and Venezuela in recent years. And high interest rates on savings is no guarantee of hot money inflows into a country that might help to stabilise the exchange rate. So this chart shows Turkish deposit rates, 17.5% in May 2021. Those deposit rates are among the highest in the world. Argentina and Venezuela are above it, as you'd expect, I guess. But even that, with inflation of 20% or more and a high level of currency risk, 17-18% deposit rates on savings are very unlikely to attract retail investors into the Turkish banking system. The final point I really want to make is there's this one. It's sometimes called the exchange rate illusion. So Turkey is a big economy, top 20 in the economy in the world by GDP, and it's a growing economy. But although Turkish growth is strong relative to other emerging countries, 5, 6, 7% is pretty strong growth by any international standards. In fact, GDP per capita measured in US dollars has fallen since 2013. Fallen by almost a third, from about $12,500 US dollars to 8,500 in 2021. Because of course we measure relative living standards by dollars, and the Turkish lira has fallen against the dollar by so much that the dollar value of GDP per capita in Turkey has fallen. Inflation is high, it's damaging the real value of people's savings, and that limits their mobility of labour for those wanting to leave Turkey to work or study. The Turkish government's responded by raising the minimum wage by 50% to hit soaring inflation, to try and offset the effects of inflation going up. I'll leave it to you to think about why they would have done that. It's obviously designed to protect real incomes, but what are the risks, what are the dangers of lifting the minimum wage by 50%? Are you impossibly at risk of embedding the inflation in the Turkish economy and creating, if you like, a wage price spiral? Has this increase in the minimum wage essentially been caused or been driven by political motives? Well, the collapse in the lira is one of the most important economic stories around just now. Young people are suffering high unemployment, a dramatic fall in their real purchasing power. Many want to leave. Relative poverty is increasing since inflation in the prices of everyday goods is having a regressive effect on the distribution of income. The growth that the Turkish economy has enjoyed over many years is at risk from the sharp fall in the lira. Erdogan's unconventional monetary policy runs counter to what the textbooks would say. And I would suggest that keeping an eye on the Turkish economy is a great way of bringing together quite a few different aspects of your Year 13 macro course. Okay, well, hopefully you found that a useful little revision session on the economics of a collapsing currency. Turkey is pretty close to home in terms of European economics and Year 13 macro. It's a great example to think about. So thank you for joining. Stay safe, stay well. We love having you visiting our economics videos, and see you again sometime soon.